Most traders believe the same dangerous risk. To make money, you need to trade bigger. Bigger size, bigger risk. One home run trade that doubles the account. And small trades, they feel pointless, irrelevant, like you're wasting your time. Position sizing matters more than your entries, more than your strategy, more than your journaling. Here's why. Position size doesn't just control how much you make or lose, it controls your psychology. It controls how your brain functions under pressure. And once your size crosses a certain threshold, your personal psychological threshold, your ability to think clearly starts to disappear. When you're oversized, you don't trade the charts, you don't trade your edge, you trade your account balance, you trade your emotions. When you can't stick to your plan, the first thing you do is blame yourself. You tell yourself you lack willpower, mental strength, the right mindset. You think the problem is your character. But that diagnosis is wrong. The real issue isn't who you are, it's what's happening inside your brain. When the risk on the table exceeds what your nervous system can quietly tolerate, your brain shifts into protection mode. And in that state, following a plan becomes genuinely impossible. You're not weak, you're not undisciplined. Your brain is simply doing exactly what it was built to do. It's not a personality flaw, it's biology. You're not undisciplined. Your size is too big for your nervous system. Every struggling trader shows the same 4 patterns. 1. Hesitation on entries. You see a valid setup. You know it's good, but you freeze, wait for confirmation, talk yourself out of it, and then watch it work without you. 2. Moving your stop loss. You placed a logical stop, but as price approaches it, the loss feels unbearable, so you move it. Sometimes the trade comes back and you feel smart. Most of the time, it doesn't, and a small loss becomes a large one. 3. Cutting winners early. Profit feels fragile when size is big, so you exit too early, then watch the trade continue without you. This isn't a targeting problem, it's a position size problem. 4. Holding losers too long. When you're too big, you freeze. You hope the trade comes back. You hold through your stop. You hold through your rules, because closing it would confirm failure. All 4 mistakes share the same root cause. The position is too large for your mind to handle. When you finally drop your size to a level that feels almost trivially small, something shifts. The internal noise quiets down. You stop fighting your own plan. Losses don't derail you. Wins don't inflate you. The market didn't become easier, your relationship with risk changed. And that single change unlocked everything that strategy and experience alone never could. When size is small enough, you become emotionally neutral, not euphoric on wins, not crushed by losses, just objective. You can follow your rules without internal conflict. No emotional negotiation, just calm execution. You let probabilities play out. You stop needing to be right on every trade. You treat each trade as one event in a long series. Consistency becomes possible. Same process every day without drama. Here's something the financial gurus on social media will never put in their thumbnails because it doesn't make for a good headline. They sell you the dream of doubling or tripling your account in 24 hours. And yes, those numbers look glorious on screen, but profit percentage alone means nothing. What actually builds wealth is the number of quality trades you can execute consistently over time. Now let's look at 2 traders, both starting with $150. Trader A chases 20% profit per trade, aggressive, exciting, and because the target is so high, good setups are rare. Realistically, he finds 7 viable trades per month. If every single one hits, no losses, perfect execution, he ends the month with $536. Trader B targets just 2% per trade. Lower bar, far more opportunities. He executes 150 trades that same month. His profit ratio is 10 times lower than Trader A's. His result? $2,924. The trader chasing the big wins made $536. The boring, consistent trader made $2,924. Same month, same market. The lesson isn't about finding better setups. It's about understanding that trading smaller actually grows accounts faster than trading big. Small size, consistency. Consistency compounds over time. Big size, volatility in your equity curve. Volatility destroys compounding. You don't build long-term trading income with one heroic trade. You build it by surviving thousands of ordinary ones. Here's a real story that illustrates exactly how this plays out. A trader starts with $30,000. He's genuinely good. Gets his account up to $52,000 in 2 months. Then overconfidence sets in. He starts risking 10% per trade and hits a rough patch. 5 losses in a row, account drops to $31,000. Then he panics, raises his risk to 20% to recover faster. 3 more losses, account drops to $16,000. Then 40% per trade on pure emotion. 3 more losses, account is now under $3,400. Big position sizing, big loss, bigger sizing to recover, catastrophic loss. That's the death spiral. Safe traders never enter it because they never take that first devastating hit that starts the panic cycle. And here's the brutal math. Risk 10% per trade and take 5 losses in a row, now you've lost almost half your account. To recover from a 50% loss, you need a 100% gain just to break even. Risk 1% per trade and take 5 losses, you're down 5%. You need a 5% gain to recover. One trader needs a miracle. The other needs a decent week. That's the entire difference. And here's the asymmetry that makes this even more brutal. A 10% loss only requires an 11% gain to recover, manageable. A 50% loss requires a full 100% gain just to get back to where you started. That's not just a financial setback. It's months, sometimes years of your life spent digging out of a hole that proper risk management would have prevented entirely. Every strategy, no matter how good, will produce consecutive losses at some point. 5 losses in a row, 7 losses in a row. It's not a question of if, it's a question of when. Your strategy isn't broken, it's just probability doing what probability does. The question is, how much damage does a losing streak do to your account? But first, I want to thank our amazing community. We selected the user who helped another community member, and we're gifting them 1 free month of Flux charts. Because that's how a community should work, by helping each other out. Please reach out to our email to claim your free subscription. Now, if you haven't heard about Flux charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part. 90% of their indicators are completely free. Plus, you can use Flux charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. Run the numbers on a trading simulator with a 60% win rate, better than most traders ever achieve, and here's what you'll find. Risk 20% per trade. Your maximum potential drawdown reaches 86.5% of your account. Nearly everything gone. Risk 50% per trade. That number climbs to 99.2%. Total wipeout. Risk just 2% per trade. Your worst case drawdown drops to 9.7%. Painful? Slightly. Survivable? Absolutely. That's the difference between staying in the game and being forced out of it. When you risk 1 to 2% per trade, the math works with you. Consecutive losses are an inconvenience. When you risk 20% or more, consecutive losses are a catastrophe, and no strategy on earth can save you from the arithmetic. You want to know what the professionals, the ones managing millions and billions, risk per trade? Between 0.5% and 2%. Some go as low as 0.25% on individual positions. These are people with entire research teams, advanced algorithms, decades of experience, and they play it safe. Why? Because they've learned that staying in the game is more important than any single trade. Survival is the prerequisite for success. The greatest traders have a simple rule. If a position makes you uncomfortable, get out. That only works when your positions don't terrify you in the first place, and that's only possible when your size is right. Trading small feels like you're not trying hard enough, like you're settling, and for someone competitive, that feeling is almost unbearable. The great Mark Minervini said there are two types of traders living inside every one of us: the builder and the wrecker. The builder is disciplined and methodical, trusts that results will come through consistency, learns from every mistake, and stays committed to the process. The wrecker has a completely different mindset, always looking for someone to blame when a strategy fails, driven by ego, fixated on short-term results, and never truly committing to a system. The critical insight is that both of these exist inside you simultaneously. The trader you become depends entirely on which one you choose to feed. Most traders who oversize their positions are feeding the wrecker without realizing it. The need to feel significant, the urge to prove something, the inability to accept small results. That's not ambition. That's the wrecker dressed up as confidence. But that discomfort isn't wisdom, it's ego. Your ego needs to feel powerful. It needs the position to be big enough to matter, big enough to impress, big enough to prove something to yourself, to others, to the market. The problem is, the market has no interest in your ego. It doesn't reward intensity or confidence or commitment. It simply moves according to probabilities. And your job is to align with those probabilities as cleanly as possible, without emotional interference. Every time you size up to feel significant, you're making the trade personal. You're no longer participating in a probabilistic event. You're putting your identity on the line. And once your self-worth is tied to the outcome of a trade, objectivity is gone. The traders who last are not the boldest. They're the ones who stopped needing the market to validate them. Here's a practical framework you can use right now. Try risking $100. If that feels emotional and uncomfortable, lower it. Try $50. Still emotional? Lower it. Try $25. If at $25 you feel clear, calm, and objective, that's your threshold. Start there. Build consistency there first. Then, once you have months of consistent results, raise your risk gradually. Not from $25 to $100 in one jump. Go $25, $40, $60, $80. Each small step conditions your nervous system to the new level. And remember, if you can't make money consistently at $25 risk, you will not make money at $100 risk. You will just lose it faster. The ultimate mindset shift is this. The goal in trading isn't confidence or excitement, it's emotional neutrality. The ability to treat every trade as one event in a long series of probabilistic outcomes. Amateurs ask, how much can I make today? Professionals ask, how do I ensure I'm still trading next year? Reframe what success even means. Measure it not by profit this week, but by how calmly you executed, how closely you followed your rules, how little emotional interference you had. Because if you execute well consistently, profit is the natural result. The market is not a test of courage. It is not a place where boldness is rewarded. It is a place where patience, restraint, and emotional stability are rewarded over time. Professional trading is boring. Your palms shouldn't be sweaty. You shouldn't be pacing back and forth. Everything should be cool, calm, and collected. Trading smaller won't give you stories to tell at dinner. It won't generate screenshots worth posting, but it will do something far more valuable. It will keep you in the game long enough for your edge to actually work. The market will always be uncertain, but your relationship with risk doesn't have to be. And when you get that right, everything else in your trading will have a chance to work. Trade smaller than you think. Survive. Compound. That's how it's done.